Thank you for joining us today for this workshop, Building Credit from Scratch. As she said, my name's Stephanie. I'm a Partner Experience Manager at GreenPath Financial Wellness, which means I work with all of our credit union partners, just like and including Sparrow, who come alongside their members on the journey to financial wellness. So this is today's agenda. During our workshop, we will be taking a look at what credit is, why credit is important, how to build credit, as well as we're going to bust some of those credit myths and talk about healthy credit habits to practice moving forward. So you can go to the next slide. Before going any further, let's get right into our first big question. What is credit? So next, at its core, credit is an agreement between an individual and that creditor in which the individual receives something now with the understanding that they will pay that creditor back later. This can come in a variety of forms like a loan, a credit card, or a line of credit. A credit report is something that shows your credit history and all the activity on open credit accounts. So this shows how you've handled credit accounts in the past, as well as how you are currently handling your credit. Things can typically stay on your credit report for between 2 and 10 years, if not longer, if they are open and in good standing. There are 3 credit bureaus that generate credit reports: Experian, Equifax, and TransUnion. It is possible that there may be differences between these 3 reports. Some smaller banks, some credit unions, and collections agencies only report to one bureau and not all 3. So it is very important when you review your credit report to review all 3 of them. And you can access free copies of your credit report from all 3 credit bureaus at annualcreditreport.com. And it is recommended that you do so at least once a year to review your reports for accuracy. Your credit report will typically include some personal information like your address and employer, as well as history and information about your credit accounts, bankruptcies and collections accounts, as well as a list of who has accessed your credit reports, which is known also as credit inquiries. Your credit report does not include your income or any assets or savings that you may have. And then your credit score. This is a 3-digit number that uses the information from your credit report to help creditors predict how likely you are to pay them back as agreed if they choose to extend the credit that you are requesting. Basically, creditors use your credit score to measure how risky it is for them to offer you a loan or give you a credit card with a certain available limit. I will say that one thing it is important to mention, just because you have a high credit score does not mean you are financially healthy. It is possible to have a high credit score while carrying a lot of debt and having no savings, just like it's possible to have a low credit score due to not having hardly any debt but being financially stable overall. There are 5 factors that make up and impact your FICO credit score. The largest of which is payment history. So making every payment on time every month is one of the very best things that you can do for your credit score. The second largest factor impacting your score is account amounts owed, which includes credit utilization. Creditors want to see loan balances decreasing, not hovering or increasing over time. This can often happen with student loans or finance loans. Also, they factor in the number of accounts that have balances. So credit utilization specifically looks at revolving accounts like a credit card, where your balance could go up one month or down the next. It also looks at how much of your credit limit you are using. The more of your credit limit you are using, the more risk you are to a creditor. So if you add up all of your revolving balances and divide them by the total of your revolving limits, that is your utilization number. So ideally, you do not want to use more than 30% of your limits at any time. And if you can, ideally, you would want to pay off those balances monthly. Length of credit history looks at how long your credit accounts have been open. So this includes the age of your oldest account, the age of your newest account, and the average of all your accounts. The longer your credit history, the better. Up next is new credit, which is also known as hard inquiries. When you apply for credit, that creditor will typically do what is called a hard inquiry, which is when they dive deeper into your credit report and credit score to assess their risk. If you start applying for multiple new forms of credit frequently, this can be a red flag to creditors because they start to wonder, what's going on, that you suddenly need a new credit card one month, a new loan the next month, and now you're asking maybe for another new credit card this month. Of course, we typically all need to apply for credit from time to time, so it's understood. But the key here is being strategic with when you do apply, limiting those hard inquiries to only when you need it. And then those hard inquiries typically remain on your credit report for up to 2 years. And finally, credit mix is the last factor that impacts your credit score. Creditors want to see that you have a history of managing different forms of credit at the same time. For example, maybe a credit card and a car loan and a student loan. This is one of the smallest factors impacting your score, but it can help to have a well-rounded mixture of types of credit when they're all being managed responsibly. And those are all the things that impact your credit score. So while it's possible to have a zero credit score if you have no credit history at all, if there is anything on the report, the minimum score would typically be 300, which would be considered a poor credit score all the way through 579. Once you hit 580 through 669, that is considered fair. 670 to 739 starts being considered good, with 740 to 799 being very good, and anything over 800 falling under the category of excellent. The average score in the United States varies a bit from year to year, but almost always falls somewhere in that good range of 670 to 739. Okay, so now that we talked about, what is credit, what impacts it, why does it matter to you, why is credit important? Your credit history or credit score can impact your ability to rent or purchase a home and turn on utilities in your name. Your ability to get and keep some jobs. Some jobs will require a credit check before a job offer is extended, and some will periodically review your credit throughout your employment. So this includes, but is not limited to, military clearances. Credit can also impact your ability to open a bank account and, of course, access loans or credit cards, as well as miscellaneous other things, including car insurance rates, cell phone plans, and a lot more. So even if you are able to get a credit card or loan with a lower credit score, you may pay more to have access to that credit. Creditors may charge you a higher interest rate as a way to account for the higher level of risk they are taking on by extending credit to you, considering that you do have that lower score. So an example of this, I just looked up these numbers today for South Carolina. This is a chart of interest rates on a 5-year car loan for $20,000. As you can see, the interest rates, monthly payments, and total interest paid vary dramatically between the poor credit score and the very good or excellent credit score. And even in between that super high range and that second to highest range, they vary quite a bit. In fact, someone with very good or excellent credit score would save more than $5,000 in total interest paid compared to what they would have paid if their score was poor. And $5,000, it's a lot of money. So this is a prime example of why building credit history, and specifically positive credit history, is so important. All right. So how does someone establish and or build credit history? One of the first things I always want people to know is that building credit history absolutely does not mean having to go into a bunch of debt. It is absolutely possible to build credit history without carrying large debt balances and paying a bunch of interest. And how do you do that? I'm so glad you guys asked. You know how you have to have experience to get a job, but at the same time, how do you get experience without being able to get a job? Credit can kind of feel the same way. Creditors want to see credit history to measure the risk of extending credit to you, but how can you get credit history without having credit extended to you? So similar to getting an entry-level job to start building job experience, there are credit building products that are specifically designed to help you start building credit history with protections in place to help minimize the creditor's risk. So one way to build credit is a secured credit card, which requires a cash security deposit to open the account. This security deposit reduces the risk to the lender because if you don't pay your card, they have the money from your deposit to pay that back. People with no credit or bad credit often start with a secured card so that they can build or establish credit. The deposits for them, they're generally low, on average between $200 and $500, but they can also be higher. With a secured card, you are still required to make a monthly payment on time or risk it reporting late to the credit bureaus. And your deposit is not used to pay for purchases. You are charged interest on the balance you carry over to that next month. So it works pretty much like a credit card. You just have that deposit as protection. Another credit builder product is a credit builder loan. The loan amount borrowed is held in an account where you can make payments. Generally, you can't access the money until you have fully repaid the loan. So essentially, you're building a savings while making payments to increase your credit score. There is no risk to the lender because if you don't make your payments, they don't actually have to give you any money, or you haven't gotten the money yet. It is important to make your payments on time or you will see that negative reporting to the credit bureaus. And then a similar product is called a certificate secured loan. So if you have money in the bank, you can use it as collateral for that loan, effectively taking a loan against your own money. The money is frozen until you repay the loan. So an example is having $800 in an account at your bank or credit union frozen, and you receive an $800 loan. Then you pay $80 for 10 months, and once it's repaid, your $800 deposit is unfrozen. And then this example I just said is, of course, excluding any interest charges. If someone you trust has a credit card in their name, they could add you as an authorized user to start building some credit history. Typically, accounts where you are an owner have more impact on your credit, but being added as an authorized user can be a good way to start establishing some credit history. There is some inherent risk in this because if the individual maxes out the card, misses a payment, this can negatively impact your credit as well. But if you trust the person, this can be a good option to start establishing some credit history until you're able to get an account in your name. I'll say as an example of this, my parents added me to their credit card when I was in high school. My mom's worked at GreenPath for over 30 years, so they're pretty good at managing their accounts and cards, but that helped me build some credit history for when I decided to lease a car at some point. When I decided to get my own credit card, I had some history built up from my parents. So if you're in a situation where you have had credit history in the past and then some life things happened, your credit suffered, and now you're looking to rebuild positive credit, know that it is absolutely possible to do so. It will require some patience, but many of the same strategies we just talked about to build credit from scratch apply to rebuilding credit after something like a bankruptcy, a foreclosure, or repossession, or if you simply haven't used credit for like 5 to 10 years or longer. If you're looking to rebuild positive credit and you still have outstanding balances owed, prioritize paying those off. If you have collections or charge-offs, which is when an account falls far enough past due that the creditor begins attempting to collect the full balance owed instead of just the amount past due. So they're essentially collections accounts. Work on a plan to get those collections and charge-offs paid off too. The same credit building products we just talked about, a secured credit card, credit building loans, these are good options to start rebuilding your credit as well. So part of the reason that building credit can feel so overwhelming is that there are a lot of conflicting, informations, myths out there. And some of the information out there, like I said, it's a myth. It's just flat out not true. So let's take a look at a few of the most popular credit myths and why they're not true. So one of the most common credit score myths is that you have to carry a credit balance from month to month in order to build credit. Not only is this not true, but it is a myth that can actually end up costing you money in the long run. When you get your credit card statement every month, there is a statement balance and it shows the minimum payment due. To avoid a late payment, you need to pay at least that minimum payment due by the due date. However, if you only pay the minimum payment and there's a difference between that minimum payment and the statement balance, when your next statement cycles, you will typically owe interest on that statement balance amount that you did not pay. So an example of this is your statement balance being $50, your minimum payment due is $20. You pay that $20 on that due date or before that due date, so you've made your payment obligation. But when your next statement cycles, you will be charged interest on that $30 difference. If you pay the full $50 statement balance, you will typically not be charged any interest. Some people believe that they must only pay the minimum monthly payment and make sure that they are carrying a balance into the next month to build credit, and that's just simply not true. We encourage you to get in the habit of paying off the entire statement balance you owe in full when you get your statement each month, because this saves you money on interest charges and will help you keep your balances lower, which improves your credit utilization. Credit cards, they're not extra money, and you also get charged for having a balance each month with that interest. Another myth is that all credit scores are the same. There are two credit scoring models. There's the FICO and Vantage, Each model determines credit scores differently, and the scores, they're not the same. Scores can vary dramatically, so just keep that in mind. 90% of conventional mortgage lenders use FICO scores when determining credit worthiness and extending credit. So things like Credit Karma, Credit Sesame, CreditWise, they all use the Vantage score. Majority of the time, if you are receiving free credit score, it's likely Vantage, unless your financial institution or credit card company provides it to you. You will be able to know what score you are seeing, because it will say when you see the score whether it is Vantage or FICO. Credit Karma may say that you have a set at 710, but when you apply for an auto loan at your financial institution, they may see a 660. So if you want accurate FICO score, most of the time you must pay for it. You can go to the credit bureaus directly or go to myfico.com if you want to see your actual FICO score. While technically having more available credit limits can help improve your credit utilization, this is a dangerous game to play. When you open a new credit card, you have a new hard inquiry and you have a younger account and your length of credit history, both of which can negatively impact your credit score. Also, the more credit cards you have, the trickier it can be to keep track of due dates and make all the payments on time, and there is more potential for you to get in over your head with balances spread across multiple cards. While there is no magic number of cards it's best to have, I would say no more than 2 or 3 is typically recommended. Some people think after paying off a credit card that they should close it, so this can also negatively impact your credit score. You will lose the length of credit history from that card, and it can impact your utilization. Once you open a credit card, it's best to keep it open as long as you are managing that card responsibly. I know my dad's had a Discover card since he was in college. I'm not going to age him, but a long time ago. So his credit history, he always uses that card, keeps it under 30% utilization, and that length of credit history is super helpful for his credit score because he's been managing that account responsibly for that long amount of time. And then we talked earlier about reviewing your credit report and the differences in credit score monitoring tools. We also talked about how applying for credit leads to a hard inquiry, which can start to negatively impact your credit score. So some people with those two facts believe that checking your own credit will also hurt your credit score. So there are 2 types of credit inquiries. There's a hard inquiry, which is what a creditor or lender will typically use to deep dive into your credit history and measure their risk level at extending credit to you. Hard inquiry indicates you have applied for credit, and as we discussed earlier, can start to negatively impact your score if it is done too often. When you check your own credit for educational or monitoring purposes, this is what we call a soft inquiry, and it does not impact your credit score. It is really important to review your credit reports and keep an eye on your credit score so you can react quickly if you notice something like fraud or something just isn't tracking correctly, it doesn't quite seem right. And the good news is that you are absolutely free to do this without concern of it impacting your credit score. So it's imperative that once you get access to credit, you practice healthy credit habits to ensure you're building positive credit history. So before I kind of wrap things up today, here are some important tips on healthy credit habits to practice whether you are starting from scratch or working to rebuild positive credit. So as I said earlier, that payment history is the largest factor that impacts your credit score. Missing or being late on just one payment can have a quick negative impact on your score, and it will take a while to build back up from that drop in your score. This is why it's important to make every payment on time every month. If you're concerned about keeping track of due dates, I absolutely recommend setting up automatic payments so you can make sure your bills are paid on time every month and you don't have to worry about that score drop. I also mentioned credit utilization, or where your credit card balance is compared to the maximum limit. This is the second largest factor that impacts your credit score. So strive to always keep your balance below 30% of the card's maximum limit. If you can, keep it below 10%. Ideally, if you can, I know it's not easy, I know I don't do it, is pay off your card in full every month. Pick one specific small budgeted expense to use your card for every month, something like the gas for your car or a subscription service. Use that card just for that purpose. That keeps the balance low, and then pay that full balance off when you get your statement for the month. This is a great way to build positive payment history while keeping a low balance and avoiding interest if you're paying off that full balance monthly. Of course, most of us are not going to need to apply for credit from time to time, which is understood, or we are going to need to apply for credit from time to time. So be sure to be strategic when you do. Instead of frequently applying for accounts you do not need, that can negatively impact your score. So if you do want to shop around for the best rates on something like a mortgage, get all of your ducks in a row and apply with multiple lenders in a short time period to have it count as one hard inquiry instead of multiple. This allows you to have the opportunity to shop around for the best deal without having more of an impact on your score. So if you're kind of doing it in a longer period of time, those hard inquiries hit your credit report, they can affect your score, and then the next time someone hard inquiries your credit report, they'd see that the score dropped. So if you do it in that short period of time, they usually don't see those hard inquiries all done in a row, and you can avoid them seeing any sort of drop in your score. Collections can stay on your credit report for up to 7 years and can have a quick negative impact on your credit score. Collections accounts can include everything from car insurance, cell phones, cable equipment that wasn't returned, medical bills, rental leases broken early, and more sent to collections, and they weigh heavily on someone's credit. Some people ignore collection accounts because they think they should not be on there because the bill was paid or it wasn't errored. Take care of this as soon as you get a past due bill or get a notice. It's super important. Ignoring it can be bad because you can think, it's not a legitimate thing. It's not going to just disappear because you don't think it's legitimate. It can make it harder to get taken care of later if you don't take care of it right away. And if you think that it's something that's not legitimate, talk about it with the collection agency, talk about it with the credit reporting bureaus as well. You can dispute it if it's not accurate. And then review your credit reports from annualcreditreport.com annually to ensure everything looks correct and that you are aware of everything that's on there. Checking your own credit report and or score does not impact your credit score. Reviewing it for educational and monitoring purposes is definitely different from a hard inquiry, which does impact your score. It's important to know credit scores are not on your free credit report. So you may be familiar with some of the online tools like Credit Karma that offer that free credit score. And while these can give you a rough idea of where your score may be at, it is important to take the score provided with a grain of salt, as it's typically not the most accurate one you'll see, or up to date. So if you were to go to a credit union or a bank and apply for credit, and there's a good chance that the credit score that they pull will be different than the one that you see on Credit Karma or on those other apps that you get it for free. Your credit union or creditor may have a free credit score monitoring tool available within your account, so check with them to see. And then, of course, check to see if it is that FICO score or that Vantage score that you are getting for free too, to make sure that it's making sense. And then finally, did I mention making every payment on time every month? This is huge, guys. It's worth repeating. It makes a huge difference on your credit. That payment history is 35% is the hardest, the biggest thing that impacts your credit score. If you're doing that, you are going to build positive credit history, point blank. The other things don't affect your credit score as much. So just as long as you're prioritizing that every month, that is the biggest impact, and that you should see positivity out of that.